This evening, Netflix released their first quarter results, and the stock is down 26% already. Let's go through their 12-page press release they just posted on their website. Revenue growth has slowed considerably. Streaming is winning over linear. Linear is just regular TV. And Netflix titles are very popular globally. However, our household penetration, when including the large number of households sharing accounts, combined with competition, is creating revenue growth headwinds. The big COVID boost to streaming obscured the picture until recently. We are working through improvements to our service and more effective monetization of multi-household sharing. Our success has been our ability to create amazing entertainment from all over the world. We believe we have the foundation from which we can both significantly improve and better monetize our service longer term. When a company releases earnings, two things can affect the stock price. Whether the company reports good earnings or poor earnings, that's one, and also the company's forecast for the future. This company has an X in both categories. Their revenue of $7.9 billion is higher than the previous 4 quarters. But the reason there's a sell-off is because their revenue growth is only up 10% year over year. In prior quarters, it was well over 15% into the 20s. This is a major concern, seeing their revenue growth decline, because the expectation is the decline will continue. Their margins were really good though in the first quarter, 25%, triple Q4, higher than Q3, and it was in line with Q1 and Q2. Really solid net income of $1.6 billion, much higher than Q4 and higher than Q2 and Q3. But the reason their stock went down so much is because this is the first quarter their memberships have declined. Every single quarter their memberships go up until Q1 22. It went down from 221.8 million to 221.6 million. Not only that, the company is forecasting another decline down to 219.6 million, an even bigger drop. When the company provides these forecasts, the analysts at all the banks have to revise their models. And when they do that, they realize the stock is overvalued and there's a huge sell-off. Because the institutions really move stock prices, not us, the retail traders. My favorite stat is cash flow from operations, and that was really good. Over 900 million, a lot higher than prior quarters, and free cash flow of over 800 million. And their shares outstanding were lower than prior quarters. In the near term though, we are not growing revenue as fast as we would like. COVID clouded the picture by significantly increasing our growth in 2020, leading us to believe that most of our slowing growth in 2021 was due to the COVID pull forward. More people were stuck in their home than ever due to COVID, so that's why subscriptions went up a lot more than expected. Now we believe there are 4 main interrelated factors at work. It is clear that the pace of our growth is partly dependent on factors we cannot control, like the uptake of connected TVs, the adoption of on-demand entertainment, and data costs. We believe these factors will improve over time, so that all households will be potential Netflix customers. This is the second of the 4 reasons. In addition to our 222 million paying households, we estimate that Netflix is being shared with over 100 million additional households, including over 30 million in the US-Canadian region. They want to try to limit people sharing their account so they can charge each person. That could be really difficult, trying to stop people from sharing their account. The third factor is viewing with linear TV, as well as YouTube, Amazon, and Hulu has been robust for the last 15 years. However, in the last 3 years, lots of new streaming services have popped up. 28.6% of the time people spend watching TV is by streaming. Netflix is still number 1. They control 6.4% of that 28.6%. They're bigger than all of YouTube, which is 5.7%. Last year they were tied. Hulu is at 3%, Amazon Prime 2.3%, Disney Plus 1.7%, and all the others 9.5%. And the fourth factor is sluggish growth from the Russia-Ukraine conflict. We are doubling down on story development and creative excellence, which we see reflected big in Q1 22. Like for example, Bridgerton, Inventing Anna, that was a really good program, and films like Tinder Swindler and The Adam Project. On the product side, we added Double Thumbs Up, so members can better express what they truly love. Another focus is how best to monetize the 100+ million households using another household's account. This is a big opportunity as these households are already watching Netflix. Sharing accounts has helped fuel our growth as more people enjoy Netflix. We will not be able to monetize it all right now, but we believe it's a short to midterm opportunity. We also plan to grow average revenue per membership. Over the long term, much of our growth will come from outside the US. Netflix is now producing films and TV in more than 50 countries, with a high degree of integration in the local entertainment ecosystem, resulting in the creation of blockbusters from every region. 3 of the 6 most popular TV shows were non-English. Squid Game, really good one, La Casa de Papel Part 4, and All of Us Are Dead. I couldn't get into that one. Those 3 shows accumulated 561 million hours in their first 4 weeks. We plan to sustain double-digit revenue growth, increase operating income even faster, and generate growing positive free cash flow. Our 10% revenue growth in Q1 22 was driven by an 8% year-over-year increase in average streaming paid memberships and 2% year-over-year growth in ARM. Their operating income of $2 billion beat the forecast of $1.8 billion. That was mainly due to lower content expenses. They lost 200,000 members in Q1. The forecast was a gain of 2.5 million to 4 million. They say a big reason was due to Russia losing 700,000 accounts. If it wasn't for those 700,000 accounts, they would have been positive 500,000, still below their target. In Q2 2022, they're forecasting a loss of 2 million members versus a gain of 1.5 million last year at this time. In Q1, they generated 923 million of operating cash flow versus 777 million last year. Free cash flow is also up from 700 million to 800 million. During the first quarter, we completed 2 acquisitions, a visual effects company, Scanline, and a gaming studio, Boss Fight Entertainment. And those 2 acquisitions combined cost them $125 million. They plan to purchase the Finnish company Next Games. That should be in the second half of this year. Their debt at the end of Q1 was 14.6 billion, after paying 700 million on senior notes, which is within their range of 10 to 15 billion, although at the top of the range. They do have cash of 6 billion, so their net debt is 8.6 billion. They have a 1.3 LTM leverage ratio. LTM is last 12 months. The way they calculate their leverage ratio, it's net debt over adjusted EBITDA. I'll show you the calculation at the end of the video. In terms of ESG, we reduced 14,000 metric tons of emissions, which keeps them on track to cut 45% of their emissions by 2030. They now have more women on their workforce, 52%, than last year of 49%. They've also increased the number of Asian, Black, Hispanic, Middle Eastern, Native American, and Pacific Islander employees. In the US and Canada, they lost 640,000 members. In Europe, Middle East, and Africa, they lost 300,000. They said earlier if we added back the loss from Russia, we would have had net additions. Even if they didn't lose anyone from Russia, they would have still had a negative in the US and Canada, which is their biggest market. In Latin America, they lost 350,000 members. Asia Pacific is the only region they grew at, 1.09 million. Here's their income statement for the first quarter. Revenue of 7.9 billion. Up from 7.2 billion in the first quarter of 2021. Operating income of 2 billion, a lot higher than last quarter, more than triple, because last quarter they paid a lot for content costs. I'll show you on the statement of cash flows in a little bit. Their earnings per share in the first quarter is $3.60. Last quarter was $1.37. Last year it was $3.85. Their shares outstanding of 444 million is up slightly from last quarter. Cash is down slightly from last quarter. Current assets of 8.1 billion. Current liabilities of 7.7 billion, so their current ratio is above 1. This is their statement of cash flows. In each accounting period, their CFO is lower than their net income. That's mainly due to content costs. They spent 5.7 billion last quarter. This quarter was 3.6 billion. Content costs get amortized. And here's the amortization of content costs, 3.2 billion. Amortization is expenses for all the content they bought for the past 10-15 years. The addition is only for the current quarter. Last quarter they spent 788 million in acquisitions, this quarter 125 million. This quarter they paid down $700 million of debt. I skipped over this line earlier. We did not engage in share repurchases this quarter. This is the last page of the press release. This shows us how they calculate leverage ratio. They take the adjusted EBITDA. Adjusted EBITDA is net income. Then you add back interest, taxes, depreciation, and amortization. But when it says adjusted, sometimes the companies add back more. They added back $421 million of other expenses, $780 million of provisions for income taxes. We add back depreciation and amortization of $250 million and stock-based compensation of $415 million. You see, it doesn't say EBITDAs, earnings before interest, taxes, depreciation, amortization, and stock-based compensation. But the company felt they should add that back in. The more they add to the EBITDA, the better the ratios look. And the way they calculate net debt, they take the total debt of $14.5 billion. Then we add back $89 million of debt issuance costs. These are all the costs related to issuing debt. The printing fees, the legal fees, and we have to minus cash. The calculation is $8.6 billion over $6.9 billion, which seems appropriate for this company. And this number can vary by the industry. In one industry, this could be an amazing ratio. In another industry, it could be terrible. So you want to compare it to their competitors and also compare it over time. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.